All right, welcome to our masterclass on private equity. Today, we're going to look past all those flashy headlines about billion-dollar deals and financial wizardry. We're going deep into what really separates the best from the rest in today's market, the art of operational value creation. So, let's just kick things off with a question that gets thrown around all the time, even in business schools. Is private equity just a fancy game of leverage? Is it all about buying a company with borrowed money, slashing costs, and then just praying the market goes up? And look, for a long time, there was some truth to that stereotype. But today, that playbook is just not going to cut it. The reality is with so much money chasing so few deals, you just can't rely on financial engineering by itself to get you those big returns anymore. The real alpha, the true outperformance, it comes from making good companies great. It's about rolling up your sleeves and fundamentally improving the business from the inside out. And honestly, this shift is probably the single most important thing that's happened in modern private equity. So how do PE firms actually pull this off? Well, they use a specialized playbook, and it starts with assembling an A-team of experts to drive that change. Think about the legendary buyout of Avago Technologies. That's a classic case study of turning a corporate division into an absolute powerhouse. That wasn't just about money, it was about bringing in very specific targeted expertise. So let's meet the key players on that team. First up, you've got the executive mentors. Now, these aren't just your typical consultants. These are seasoned industry vets, often former CEOs or top executives from that exact industry. They come in part-time, and their job is to coach a management team that, might be totally new to the high-pressure world of PE. And here's the most important part. They're usually incentivized with equity. They have real skin in the game. They win only when the company wins. It's as simple as that. Next, we have the operating partners. Think of these as the in-house heavyweights. They're full-time employees of the private equity firm itself. Their background might be in general management, or maybe they have deep expertise in something specific like supply chains or IT systems. They work across a bunch of different portfolio companies, acting as that direct link back to the firm. They can even parachute in as an interim CEO if there's a leadership gap that needs to be filled.
And all this brings up a huge strategic choice that every PE firm has to make. Do you build out an expensive in-house operating team, or do you just hire external consultants when you need them? The trade-offs here are massive. In-house teams, they give you that direct line of communication, that long-term focus, but they come with a huge payroll, and sometimes they can clash with the deal team. Consultants, on the other hand, bring in super specialized skills exactly when you need them, but the relationship can feel a lot more transactional. There's really no single right answer here. It's a fundamental decision about how the firm wants to operate.
So let me put you in the hot seat for a second. Imagine you're the CEO of a company that was just bought by a PE firm. What would you want? Would you want the insider who totally gets your new owners and what they expect? Or would you prefer the outside specialist, who is like the world's leading expert on your single biggest operational problem? Seriously, think about it. Your answer says a lot about the tensions and priorities that are always at play in these situations. Okay, this all sounds great in theory, but it brings us to the million-dollar or really billion-dollar question. How do you actually prove that it works? How do you measure the value that all these teams and initiatives are creating and separate it from just getting lucky with the market or from just using a ton of debt? For the longest time, the models people used to break down PE returns were pretty basic. They could tell you how much value came from growing revenue versus, say, the multiple expanding. But they couldn't tell you if that revenue growth happened because the management team was brilliant or just because the entire industry was on fire. It couldn't separate genuine skill from plain old luck. So, to solve this problem, you needed a much smarter model. And that is exactly where INSEAD's Value Creation 2.0 framework comes in. It was designed specifically to bring real clarity to this, to deconstruct where the returns are coming from, and most importantly, to isolate that company-specific value, the stuff created by the PE investor and the management team. Okay, check this out. This is a perfect example of how it works. Just focus on that top line, change in revenue. The total return from revenue growth was a 0.51x multiple on the investment. Pretty good. But here's the magic of the IVC model. It breaks that down. It shows that only 0.10x of that came from the whole industry just doing well. But a full 0.41x, that's over 80% of the value from revenue, came from things the company did specifically. That right there is pure alpha.
Now let's zoom out and see how this all fits into the big picture. This chart breaks down a final return of a 1.7x money multiple, and you can see it clearly. This first slice, 0.64x, that came from just riding a good market wave. This next slice, 0.38x, that came from the financial leverage used in the deal. But look at this, the largest single piece of the pie, 0.68x, that came from alpha. That's the real, genuine outperformance that justifies the entire private equity model. That's the value those operating teams helped create.
All right, now for a little inside baseball that you probably won't find in a standard textbook. We've been talking about how valuable these in-house operating teams are, but that brings up a very touchy question. Who's supposed to pay for them? And this gets right to the heart of what I call the billion-dollar disagreement. For a long time, the PE firm, that's the general partner, or GP, would just charge the portfolio company for these operational services. But the investors in the fund, the limited partners, or LPs, started pushing back, and pushing back hard. They argued, hey, wait a minute, we're being charged twice. Once through the standard management fee we already pay you, and then a second time through these extra service fees. This whole conflict has forced a major rethinking of fee structures and transparency across the entire industry.
Whew, okay, we have covered a ton of ground. So let's boil all of this down to the key lessons you really need to take away from this.
Okay, first, in today's market, operational improvement isn't just a nice to have, it is the #1 differentiator. Second, success isn't about some secret playbook, it all comes down to rigorous focus and execution. Third, firms use a smart, strategic mix of talent, mentors, operating partners, consultants to get the job done. And finally, and this is so cool, we can now actually measure what matters. We can use models like IBC 2.0 to prove exactly where that real alpha is coming from.
And look, if you remember just one thing from all of this, let it be this idea. Private equity firms don't really have secret tools that nobody else has. What they have is a unique combination of resources, incredibly powerful incentives, and, this is the most important part, the willingness to execute decisively on changes that are difficult but absolutely necessary. That is their ultimate advantage. So I'll leave you with a final thought to debate. As the industry keeps evolving and deals just get more and more competitive, are we heading towards a future where a firm's operational expertise, its ability to truly transform a business, becomes even more valuable than its ability to just find and finance the deal in the first place? That's our explainer on the art of operational value. Thanks for joining.